name's Stephen McHenry, and on behalf of McHenry Partners, we welcome you all here tonight, and thanks very much for taking your time out of your busy schedules and making an effort to come along tonight. And I'm sure the information we're going to share you is going to provide a fair bit of value and help you with your decision making in regards to your investment decisions in the future. So the format of tonight's presentation, we've basically got three speakers. I'm going to kick off and talk about investment fundamentals. I'm also going to talk about specifically about property investment and how that works from a funding and servicing point of view. Then I'm going to introduce Mike, and Mike McHenry is going to talk about superannuation, specifically self-managed super funds. Mike's an expert in that field, so we're going to talk about the benefits there. And then we're going to come home with a climax with Nicholas Don, and Nick's going to talk about property investment market, and Nick's a licensed real estate agent. So we've got a lot to fit in the 90 minutes, so we're going to have a question time at the end. If we have questions along the way, we probably won't get through all the material. So I'm going to fly through it. We've got a lot to cover. The first thing I probably want to talk about generally is that what I found in my 25, 30 years in the financial industry is that our general society is financially illiterate. And what I mean by that, and there's a reason for it, but if we think about when we finish our education, we actually develop a skill to drive an income, but no one actually teaches us how to invest and create wealth. So we're all on the even playing field. No one knows very little about investing. And basically what happens, I've found, with looking at people's histories and what they do, they generally listen to their parents, and their parents have listened to their grandparents, and they generally have very basic financial strategies and skills, and ultimately end up in not a great position when they go to retire from an income stream. So what I want to share with you is probably a lot of skills that I've been able to learn over my lifetime, and to put things in perspective from, if I had to say where I learnt my skills from, going to university and probably maybe 10% of the skills being in the accounting industry, probably 50, 60% of my skills. But I actually did invest a lot of time and effort in going to seminars and actually learning from people that have created a lot of wealth through different strategies with property and shares, and learn a lot from them, and actually then use those strategies to share with our clients. And basically we've been able to put together, in summary point form, a lot of those skills that we're going to share with you tonight. So a lot of people in lifetime don't learn all these skills. A lot of people have skills in certain areas, but don't have holistic skills to actually apply. And so we're going to share a lot of those things tonight. The first thing that I want to talk about, or give an example. I want to share an example first of all. It's a light-hearted example. I'm going to put a next slide up. It's got a sentence on it. What I'd like you to do is read that sentence. I'm not going to ask you to memorise it. I'm not going to ask you to share it. I just want you to read the sentence for us. And I'm going to give you 30 seconds to do that. Okay, now I'd like you to count the number of F's that actually is in that sentence, please. The amount of F's in that sentence. I'm going to give you 15 seconds to count the F's. Everyone done? We all done? Okay, so how many F's did we see? Did anyone see no F's? Did anyone see one F? Hands up if you saw two F's. Brian, hi. You put one. Anyone see three F's? About 8. Anyone see 4 F's? Hands up higher. About 8. Anyone see 5 F's? 5. Anyone see 6 F's? About 8. We're all looking at the same screen here? We're all looking at this screen. Did anyone see 7 F's? Did anyone see more than 7 F's? There's actually 7 F's, ladies and gentlemen, and that's... Now, the point I want to make here is in this little sentence here, if everyone has seen between 2 and 7 Fs across the board, everyone has actually seen things differently, everyone understands things differently, and everyone reads things differently. If you can also different in reading one sentence, what's it like in the field of investment, that massive field, how people read things and understand things differently? And if I had to use an analogy, if there were 7 Fs of investing, which there's not, but in theory if there's 7 Fs investing, because generally people don't have a lot of skills in this area, I generally find that there might be, at a scale of 7, there might be 1, 2 or 3 people sit. The point is there's a big perception or big gap between people's financial knowledge. That's the first point. The second point is, once you understand there's a big gap, you've got to do 2 things about it. One, you can try and learn everything yourself and take 10 years to learn everything. But secondly, what you need to do is basically leverage with other people's skill and leverage your time to actually get some financial skills behind you without trying to learn everything yourself and put things in place. Because one of the main points I want to make tonight, creating wealth is quite easy to do. It just takes 20 or 30 years to do it. And I'm going to show you examples of that. Some people say they know it all themselves, or they want to learn it all themselves, and they take 15, 20 years to do it, and then they'll end up knowing a little bit more, but then they've only got 10 years to actually create a lot of wealth. And wealth's created over a long point of time. So you've got to leverage your time, leverage other people's skills to make things happen, and get your investment strategies going. Okay, so let's put up a little disclaimer here saying obviously all this information is general information, and before you can make any specific decisions, you need to seek financial advice yourself. And we're basically going to offer a 3-hour consultation for anyone that wants to tap into our expertise, and we can help you and give you some free advice wherever you're at in your investment life. So let's start off with this slide, which we talk about how much people need in retirement. Has anyone thought about what sort of income you need when you retire? Does anyone have a guess what they need in retire? Stav, how much would you need, mate, in retirement?
Well, the maximum.
Realistic?
Oh, 50?
Yeah. Is that you? What about your wife? Is that both of you?
Oh, that'd be both.
Okay. All right. That's not too bad. See anyone off the charts? Anyone say 100,000 like this? Look, generally as a rule of thumb, whatever you're earning now is generally probably what you need in retirement as a rule of thumb. Okay. So let's say if Stavro wants $1,000 a week in retirement, how much investments does Stav need to producing $50,000 a year? And those investments don't include the family home, because if you live in your home it doesn't produce any rent. We're talking about the value of your shares, the value of your investment properties, the value of your superannuation. What value do they need to be to produce $50,000 a year?
1.5.
Yep. So using about a 5% return on your assets, 5% of $1 million is about $50,000 a year. So if Stav wanted to retire, from a financial planning point of view, we'd do, and McHenry Partners, we'd say, okay, Stav's in this situation. He's got $100,000 in super, he's nearly paid off his home, he's got 10 grand in Telstra shares. So he's at $110,000. How do we get him from $110,000 to $1 million? And $1 million in today's terms, obviously in 10 years' time, is going to be worth 1.3 or something like that. So the plan is, how do we get him from here to there? And what are the strategies that's going to create that wealth to give him an income stream? Because people can retire when they have an income stream of $50,000. And most people get to a situation where they haven't got that much. The reality is, the statistics is, the majority of people actually fall in this category here, between 20 and 30,000. So their assets outside their home is probably about 500,000. So if you're thinking you're around here, you have to do something pretty fundamentally different to the average person, because most people fall in this category here. And if I can probably really simplify basic strategies probably that's happened over the last 50 years, and my parents did it, and probably most parents, grandparents did it. You basically leave school, you get an income, you find a partner, you get married. Once upon a time you used to get married, and then you buy a house, okay, and then you have kids, and you pay off the home loan, and you focus on just paying down debt, which is a debt reduction strategy, and the kids start moving out of home, and if you're still together, then you've got probably a small home loan debt or no debt, and you say, okay, I want to retire. When I'm 5 years' time or 10 years' time, I've got $300,000 in super, $50,000 home loan, I'm short $700,000. The problem is we can't create a lot of wealth from 50 to 60. You can create a lot of wealth from 25 to 60, but not from 50 to 60. And the idea is we have to do a little bit more and be a bit smarter about how we get some strategies in place over that long period of time, because people end up in this situation because they just adopt a debt reduction strategy and not some other financial skills that we're going to talk about. So to create wealth, there's basically three elements we're going to talk about. One is saving. We have to save, and then we put some savings into an investment strategy, and that compounds over time, the investments. And if we can borrow other people's money, like the banks, to actually leverage to get more asset working for us, we're going to have more compounding happening. And those three things together will create a lot of wealth if we buy quality investments over time and hold them over time. So I'm going to dig a bit deeper into these 3 points. Has anyone heard the book written by Robert Kiyosaki, Rich Dad, Poor Dad? Has anyone read that book? Okay. So one of the key points he says in that book, he says, you have to pay yourself first. You've got to look after yourself first and everyone else after that. So if you earn $1,000 a week, you should be putting $100 aside towards an investment strategy. And the other $900 goes on taxes and paying the bills and everything like that. But most people pay everything else first and aren't left with the 10%. And you haven't got any savings, you haven't got anything, you can't do anything with that from an investment point of view if you haven't got a starting point. So that's so important, and you need a budget. It doesn't matter who you are. If you're earning 50 grand and saving 10 grand, you're in a better position than someone who earns 150 grand and saves $5,000. A true story, a month ago we had a doctor client. He referred a doctor friend to us, and the doctor came to us and said, I'm in real trouble with the tax office. I go, well, we looked at his situation. He's been earning $250,000 a year for a long time, 2 kids through private school, spends money, no problems. What's his financial position? Got $1 million house, has $1 million debt, owes $150,000 to the tax office, and the tax officer put him to receivership. How does the guy earning $250,000 a year get him in that situation? But he can't save. That's why he can't save. He doesn't save 10% of his income. He spends and then forgot about paying the tax each year. We said to him, sorry, we can't help you. It doesn't matter who you are, you've got to be able to save, and it makes a real difference over time. And your budget surplus is directed towards an investment strategy. I've got this last point, eliminate gambling losses. The odds are against you. We do a few financial welfare presentations for sporting clubs and talk to a lot of young footballers and 20 years of age, earning dollars and haven't got too many financial skills. So without going in the 10-minute presentation I'll talk about on this side of things, but from my experience in this industry and from my mathematical understanding of gambling, I just point out to people that the reason you don't gamble is because the odds are against you. Mathematically, the bank takes out too much as a percentage and you can't win over time. I'll just use a very quick example which I share with the guys. I say, look, in a roulette table there's 2 greens out of 36 numbers. Okay, the banks takes you, there's a risk of those 2 numbers come up, you lose, they pay $35 as odds, and there's 38 numbers on the table. I said in relation to sports betting or racing and what the TAB takes, the TAB takes 17% out of the pool. So to use that as an analogy with the roulette table, it'd be like there's 36 numbers, and if you get a winner of one of the numbers, you get paid odds of $30. So there's a 1 in 36 chance, but you get paid chance of $30 out of 36. So even if you pick a winner 1 in every 36, you will lose because you get odds of only $30 because the margin's 15% in favour of the bank. That's why over time you can never win gambling. And once people understand that I say, look, try and save that $50 a week, that $100 a week, because we can do some really good things with that, which I'm basically going to share with you all in a second. Okay, so the second point about creating wealth is investing. We need to invest in assets that are going to appreciate in value. There's 4 classes of assets. There's cash, managed funds, shares and property investment. I'm going to touch on property investment and talk about a bit more detail on that. Obviously I can't talk about all of them, but property investment is a pretty powerful one to get ahead financially, as I'll explain. Just want to point out superannuation is not really an asset class, it's a tax structure, just like a company or a trust. It actually is a trust. And so within that trust structure, that super fund can invest in cash, managed funds, shares and property investment. It's actually not an asset class itself. And so, okay, so when we're investing in those asset classes, the idea is we invest for a long period of time, and because we see the compounding effect happen. Does anyone know who this gentleman is? Albert Einstein, pretty smart cookie. He said the 9th wonder of the world was the power of compounding. And I want to share an example with what we probably mean of that. And this is probably a bit of a loose example, but let's put it to you. If we had put 1 cent in the jar today and we doubled it every day, how many days would it take to build up $10 million in the jar? So let's start off with the equation. Day 1 we put 1 cent in, day 2 we put 2 cents in, then 4 cents in, then 8 cents and 16. After day 1 we've got accumulation of 31 cents. Let's keep moving along. Maybe I'm jumping ahead, maybe I'm going to ask how many days it's going to take. If you saw that, you're going to probably reduce your estimation now. Anyone make a guess how many days it'll take?
40.
40 days? I should say days or years or something like that, and some people say 5 years or whatever, but 40 days, that's probably not a bad guess. All right, won't hold you in suspension. Okay, let's keep 25 days. So we're doubling each day, 167,000, that doubles 335. Day 27 we're putting in that, and day 30 we're putting in 5.3 million, which doubles the jar to 10.7 million. So it takes 30 days to build up 10 million by doubling every day. So that's sort of a roundabout way of helping explain how compounding works. But quite simply what we're trying to do is over time, let's use a property investment for example. The point is property generally goes up 6% a year. So if we buy a property worth $400,000, the first year goes up on average $24,000. But if we hang on to that property for say 15 years or 20 years and it's worth $1 million, when it goes up 6% in the next year after that, it goes up 60,000. First year 24,000, 20 years later goes up 60,000. So it's this snowball effect. At the top of the hill you let the snowball go and it slowly builds and slowly builds the first 500 metres. But 3 kilometres later, the last 500 metres, it's become a massive, surface area is massive, and it's just building and building, and that's the compounding effect of how we create a lot of wealth by holding that asset for the 10 to 30 year period. Okay, and the third point is the power of leverage. Now a lot of people, if you listen to your grandparents or your mother, they probably said, don't borrow off anyone, pay down your debt, and don't borrow off anyone. There's certain borrowings that are good borrowings and there's certain borrowings that are bad debt. So we want to talk about the good borrowings. So let's presume you all had 20,000 in your pocket, okay? What are you going to do on these 4 scenarios? Let's say you could have 20,000 in super, property, and we can potentially borrow a different loan amount against the value of those asset classes. Okay, so generally with super, if your money's going into C-bus or wherever it's going, generally in those industry funds, that they're not borrowing money. You basically got your money working there for you without borrowing. So the debt is nil. If you go and buy some BHP shares, a margin lender will say, okay, against these shares we'll generally lend up to 60% of the value of the script. The shares are security. So that means you can borrow 30,000 against the 50. And if you buy some property, we all know you can borrow up to 80% of the value of property. So you could buy with your 20,000 only, you can borrow 80 with your 20, gives you 100,000. There's a thing called mortgage insurance, which is a one-off cost, which is normally about 1% of the loan, and it allows the bank to give extra comfort and borrow up to 90% of the value. So just show the point there is that you can actually borrow another $100,000 in that scenario. And I know with the first few investment properties I bought, borrowing 90% was quite helpful, which meant I only had to put 10% into the deal instead of 20%. So all these assets go up 7.5% a year. That's a doubling effect. If something doubles in 10 years, it's gone up on average 7.5% per annum for 10 years. So in super, your 20,000 has gone to 41. Your shares, your basically your $50,000 has gone to 103. It's doubled. Your property's gone from 100 to 206. It's doubled. In this scenario, your property's gone from 200 to 412, up 212,000. So if you had $20,000, where would you like to put it? If this was a scenario, this N1? The N1. Because your gain, you could sell that, come out with 212,000, or you'd actually come out with 212 plus your 20,000 in equity. Okay, so, I mean, a lot of people say to me, Steve, you know, blue chip shares, they perform better than blue chip property. And probably as a percentage wise, yes, probably does. You know, shares might go up 8% a year. Property might go up 6% a year. But it's not about the percentage that counts. At the end of the day, it's the dollars that counts. Okay, if this share went up, not 7.5%, if it went up 8.5%, its value might be 123,000, which is an extra 20, which means you've made 73,000 gain compared to 106,000 gain. So a better performing share will still produce, in that example, less equity gain over a period of 10 years. That's the hardest slide you've got to understand tonight. So if you grappled with half of that, but borrowing off the banks and have for a good asset for tax deductible debt is good. Okay? Because at the end of the day, as we'll get to the later slide, it's about how much equity you build up in your investments, not how much the least amount of debt you've got at the end of the day. Okay, so there's 3 points I want to talk about generally about property investment fundamentals. One is how to use equity in your home to invest. Talk about the risks of property investment and what drives property growth. Okay, let's say we've got a property worth $400,000 a home and we've got a current debt of $100,000. Now the banks will lend up to 80% per the previous slide of the value of a property. Does anyone know why they actually lend 80% against property and 60% against shares? Why don't they lend 80% against shares? Less risk. All right, they only lend 6% if shares is a bit more volatile, whereas property is a bit more like this. So property investment is generally a less riskier investment than shares. Okay, so 80%. So we've got potentially borrowings of 220,000 here. So subject to income and serviceability, this person would go back to the bank and say, look, I'd like to borrow another 220,000 for investment purposes. Now, this person would like to get an investment property worth $400,000. Now, if the Commonwealth Bank has security over this property, let's say they go back to the Commonwealth Bank and say, okay, I want to get an investment property. I haven't got any cash. Love $1 for every time someone said to me, Steve, I haven't got any cash to get an investment property. I say, have a look at this slide, Appendix 25.2, and run it through with them. So 80% of the value of the investment is what the bank will lend against that security alone. So where do we get the other 80,000 from? Equity, mate. The other 80,000 over here. Okay, so the bank says, yeah, okay, the CBA's got security over this home and the investment property, so they're quite happy to lend the other $80,000. Okay, now you could actually go, if that was the Commonwealth Bank and that was the ANZ, you'd have to get an $80,000 loan from the Commonwealth Bank and a $320,000 loan from the ANZ. But because it's the same bank with same security over both, they'll give you a loan for $400,000 and leave the home loan at $100,000. Now, the bank doesn't care that you've got a 100% loan here and a 25% loan there, because overall their total loans are less than 80% of the value of the two properties. Two properties are worth $800,000. 80% of 800,000 is 640,000, and they've only lent 800, 80%, 640, and they've only lent 500,000. The other 140,000 that you could still borrow is that bit there, is equity, and you can do the same. So you can probably go and buy another investment property for 400 and use 80 of the 140 here to get another investment property. So you don't need the cash, because people have done some good work over time and paid their home loan, built the equity up. Now they can springboard that and use that to actually, it's the same thing. You could save up, instead of paying down your home loan, save up 80,000 over here and go and use that, use my deposit on the property. But you don't do that. You try and save the interest in the meantime and then draw against it to do that. Everyone cool with that? Okay, what's the main concerns we have when we're buying investment properties? What can go wrong? Give us those normal three. Quick. Interest rates go up. Can't rent it. Bad tenant. What else? Maintenance. Property goes down. Yeah, it's a nice problem to have when you sell it and you've got a capital gains. I always say that's a ripper problem to have. Well, there are three. There's probably one more in there, but we'll cover that. So, interest rates, bad tenants, no tenancy, overpriced property, we mentioned that. And the bottom one down here, which no one ever mentions, I don't know if I've had one yet, loss of income, which I believe that's the main risk with property investment. I'll talk about that in a second. Now, with any investment, there's obviously risk involved, but the idea is to minimise the risks of going wrong and putting things in place. And people always get just a lack of knowledge with this area, because a lot of people get hung up on what can go wrong and heard bad stories and heard the current affair programs. And it's not really the situation when you're buying quality property in the right area. Let's say you buy a property in Richmond for $500,000 and the rent's $500 a week and two people are paying $250 each. How much income are they on? If they're paying $250 each. They're on more than $50,000 a year. And tenants are pretty careful about doing things wrong, because then they go in the tenancy database and they won't be able to rent a property again. They've got to live somewhere. So in that scenario, finding the right property manager, buying in quality areas, attracts good tenants. When you hear the current affair show, the tenant smashed the joint, where was that? Carlton, North Melbourne? Where? Not? Anyone a bit further? You know, slow social economic areas. So you buy an average property and say, oh, this is cheap, and you get a tenant in there and you've got a poor manager, you're looking for trouble. I mean, I've had lots of investment properties over the years, and the worst thing that ever's happened with a bad tenant is broken blind, flooded washing machine, insurance covered, bond covered. You know, you just don't have any problems with that. And on the no tenancy vacancy, you know, if you get a good property, the vacancy rates, and Nick's going to talk about some of these, but I mean, generally you get with the properties I've got, generally tenants will stay for 3 years at a time, and then you'll have a 2-week break every 3 years. So, you know, it's just not really an issue if it's well managed and getting the right property. So you can fix interest rates. Going back to the top one, you can fix interest rates any time. Interest rates are low at the moment. And at some point in time you could fix them if you want. You never fix for a long period of time, but if you want to control your interest rate, you can always fix it. Obviously interest rates are tax deductible that you pay. Overpriced property, or if you do your research or use someone like Nick, provides all the research for you, you should be buying for the right price, and over time you should do well. And income protection is the main concern I've got. Heaps of people will insure their cars, but the biggest asset is their ability to earn an income. And people I've come across that have had to sell their properties is because they've either lost their job and haven't had income protection, and they can't service the shortfall on the investment property. So they're the risks. They all can be managed, and I don't really believe they're real risks, and the most important one is the bottom one. Okay, so what drives capital growth? And it gets back, everyone's done economics at school. It's the laws of supply and demand, where you've got low supply in an area and high demand that will contribute to price increases. So if we can compare Melbourne and regional areas, history says that Melbourne or Sydney will outperform areas like Newcastle or Bendigo or Ballarat. And it's because of the supply and demand factors. Obviously you drive through Melbourne, everyone's done that. Where's the land? Anyone see any spare land? No, there's not. You drive for kilometres, there's not. Whereas in regional areas like Bendigo, Ballarat, Newcastle, you drive out a bit. They can rezone farming area and redevelop into residential. And the problem with that is that's, the economy's going well, people are maybe moving in, but they're supplying land, which for prices to go up, you need a shortage of land. Because land is the value that goes up. The dwelling doesn't go up in value, the land goes up. And the reason the land goes up is because the population is moving in there and demanding and prepared to pay a rental income, a higher rental income for those properties. So it's probably really important to understand that what actually drives any asset price is the income stream that that asset produces. You value a business, it's the profitability, the income stream that it derives, it produces. You sort of buy shares, it's the income stream. You buy a property, the property will be worth depending on what rental income it derives in 10 years' time. People think properties go up for certain different reasons. The only reason property prices up is because people are prepared to pay more rent for them. And if you've got people going into an area where there's no land and fighting over existing properties and paying more rent, that will force prices up. I had a cousin that came back from Queensland and worked in a mine for 3 years. And when he went up there, he was considering buying a house. He was going to buy a house for $650,000. And he recently come back because the mine closed and the population moved out. Half the population moved out. So within 3 months, the house is worth $250,000. Same house, same dwelling, just the renters just moved out. The population just moved out. And the rent can only get for those properties now is $250 a week, not $600, and that's why it's worth $250,000. So there's a real example of what you need. The rental, what you're really buying from an investment point of view is a rental property. It's a rent that you're going to drive. I don't care where my property is, what it looks like, if it's got pink walls, how small it is. All I care about that if it's worth $400 in rent today and worth $400,000, in 10 years I expect to be worth $700 in rent a week to be worth $700,000. Is the price of a property in Colac or Geelong or Newcastle or Melbourne or Sydney, whatever the rent is today, if it's $400 a week, the property's worth $400,000. If it's $300 a week, the property's worth $300,000. And in 10 years' time, whatever the rent is, that's what the property's going to be worth. Because the rental yield's about 5% of the value of the property. Property's worth $400,000, 5% of that's $20,000 in rent a year. And if something's producing $30,000 in rent in 10 years' time, 5% multiple, that equates to, what does that equate to? $600,000, 5%. So investors will buy based on the rental yield. So it's just important to understand that rentals only go up if you've got the population demanding for those rental properties and a shortage of those properties. Okay, so let's talk about the tax effect and benefits and how we actually service an investment property and what it costs per week to run a property. But first of all, let's use the $400,000 example of buying a property. The mortgage cost is $1,700, the conveyance is $800, depreciation schedule, one-off cost, and a stamp duty of $2,000. Total property cost $405. Why is the stamp duty only $2,000 in this example? Anyone want to know? Why?
Off the plan.
Yeah, so you bought it off the plan, or it's a bit like a house and land package. You buy a block of land, you pay stamp duty on the land, you build the house, you don't pay stamp duty on the house. If you bought a unit or a house existing, you pay stamp duty on the $400,000. In that situation, it would be $17,000, $18,000. So buying something new off the plan, you actually save about $16,000 in stamp duty. So all the properties I've bought have been new because I want them new for depreciation benefits, and that depreciation schedule determines the depreciation that you can claim on that property over the next 40 years. I'm going to explain with it in the next slide what the depreciation is. And generally when Nick talks about property in, new property in places like Melbourne, that you generally have to buy it off the plan, and they construct the property over the 12-month, 18-month period. So let's use that $400,000 example. We're borrowing $405,000. Why have we borrowed $405,000 to fund the whole $405,000? How did we do that? Equity, mate. Use your equity. Okay. So if you haven't got any equity, obviously you need some cash. If you haven't got any cash, you need some good parents, relatives. In seriousness, when I bought my first couple of properties, I come out of university and I must have been late 20s. My parents were nearly retired, 54, both school teachers. I'm the oldest of 7 kids. There's 4 engineers and 3 accountants amongst us. And we come out of uni, I said to my parents, why don't we use your equity? They didn't invest in properties, and we've got the income, and we buy a couple of properties in Melbourne together. And I explain this to them. They go, okay, well, yeah, all right, we'll do that. So we did that, and we bought a couple of properties together, and we held them for 8 years, and then we sold them, and we made good gains, and that gave a good kickstart for my brothers and sisters in regards to deposits on their next properties and so on, and they were getting started to get involved in the property market as well, even before we sold them. So there's always a strategy. You haven't quite got any money or whatever, there's lateral ways of thinking about getting into the market. I digress, but getting back to this. The rental income of this property is $400 a week, $20,000 over $400,000 value, that's a 5% rental yield. Your interest cost is the main cost, 6% of 405 is $24,000. There's your normal outgoings of property. We've allowed 2 weeks vacancy in here, so this is basically rented for 50 weeks of the year. Repairs and so on, so that's $6,000. So your out of pocket 24 and 6 is $30,000 minus your rent of 20. So your cash out of your pocket's $10,000 a year, which is $200 a week. So as good tax accountants, obviously we don't claim this $10,000, just this $10,000 in your tax return. We're going to claim this depreciation as well. Now that quantity surveyor report said we can claim $9,300 in our first year and something similar for the next 39 years. Now the government's got this, the tax office has got this great rule that says, if you buy a $400,000 property and the land's worth $150,000 and the property's worth $250,000, of that $250,000, $50,000 is the blinds and curtains and all that, and $200,000 is the construction of the dwelling. And over the next 40 years, that dwelling's going to be worthless. It's not going to be worth anything, just the land. So we can claim the $250,000 over the next 40 years. That's what the depreciation is. Even though it's going to exist and still be worth $250,000, we can claim it. So what that means is we claim 9,300 plus the 10 is 19,000. So our actual tax claim, so if you're on an income, on this tax rate here, someone's on an income of 30 to 80,000 and above this is 80 to 180,000. So if someone's income is 70,000, this reduces it down to 51,000. So therefore the tax saving at 34% on 19,000 is 6,800. That mitigates your cost and per annum cost down to $3,600. We divide that by 52 weeks, it costs $70 a week. So before tax it's $200 a week, after your $130 tax savings it's $70 a week. So it becomes very affordable when you have a new property with great depreciation and a good accountant. You can get down to $30 a week. Now someone with on a higher tax bracket basically can claim that at 39% on the $19,000, and that would be a saving of $7,700. That just mitigates the cost a little bit more down to $53 a week. So if anyone can afford $53 to $70 a week after tax and has equity in their proper home, is in a really good position to do something like this. So people say to me, Steve, look, I can't afford an investment property. I'm struggling to pay the $800 a month on my home loan, let alone get another loan. This is so much different because the tax man, in the outgoings of $30,000 we talked about, we're getting rent of $20,000. The tax office is giving us $6,000, and that leaves just under $4,000 out of pocket. Whereas our own home, if we borrowed 100% for our own home, it would be costing something like $500 a week before the rent, before the tax breaks. So it's totally different and very affordable. So hopefully you all got hold of that. Really, really important. Now, let's say that property worth $400,000 grows over time. We know in CBD areas like Sydney and Melbourne, it's increased, doubled every 10 years for the last 50 years. But this scenario allows a 6% capital growth rate, which means this property worth $400,000 we just bought per the previous slide, and we borrowed 100%. So the red's the debt. Over time, obviously property doesn't go up exactly like this, but we're suggesting assumption 6% growth. So it hasn't quite doubled over 10 years, hasn't got to 716,000. The red's still the debt. Why is it still the same, 400,000?
Interest only.
Interest only loan. We haven't paid off the investment loan. If you've still got a home loan of $100,000, the strategy is you should be paying extra. If you're paying extra off, you pay extra off your home loan because that's not tax deductible, and you just pay the minimum off your investment loan because that is tax deductible. So you always reduce your non-deductible debt first before you reduce your deductible debt. So the equity in this property is now $316,000. How much was it costing per the previous slide after tax per week in the first year? $70 a week. How much do you think it's going to cost 10 years down the track? You liking the presentation? Anyone answer? How? Less. Same amount? Zero. Why should it be zero? Oh, you're saying that's... Oh, zero. Good on you. Why should it be zero?
What should be paying for itself?
What's changed?
Rent's gone up.
Rent's gone up. Okay. So the rent was $400 a week here, and property's gone. Do you think they're paying $400 a week in year 10? They're probably paying $716 a week or something like that. So therefore, what we generally find is that over time, that I generally find that with this sort of scenario that the property would sort of break even after year 12 or something like that. So it's gone from $70 a week, 65, 60, 55, 50 down to getting close to breaking even at this point. Because the rent of $700 a week is covering the interest at, if that was 6% interest of 24 grand, $2,000 a month, 500 a week. So $700 a week, interest is 500 a week, and then you've got your other expenses and so on to sort of get close to break even. Now, everyone thinks, well, maybe that's not quite sound right. Can rent go that far? Can that happen? If we're all sitting in this room 20 years ago when this Carlton property, this 2-bedroom unit or 1-bedroom unit in Carlton worth $400,000, 15 years ago, if I said the property's worth $100,000 and it's getting $135 a week rent, and in 15 years' time it'll be worth $400,000, what do you say? What? Pigs might fly? There'd be some doubting Thomases, okay? What's changed? The fundamentals haven't changed, supply and demand hasn't changed. You know, people say income levels aren't going up at the same sort of rate, but what happens, people start sharing. Accommodation and food are the most important things. You want to live close to the city. In this property, you got one person back 15 years on their own. Now they've got 2 people in here, probably paying $200 a week each. Down the track, they might have 3 people in there paying $230 each. So people live and prioritise and are prepared to pay more. So hopefully that's a pretty important slide in regards to how and obviously from this point onwards, as it goes up further, the rent goes up and it becomes positively geared. People say to me, Steve, look, am I best to pay off my home loan first and then I'll do something like this? I've got to spare $100 a week, can I pay off my home loan? Or $70 a week? And I say to them, okay, if you pay $70 a week off your home loan for the next 10 years, that's $3,500 a year. By 10 years is $35,000, and you'll save some interest, which is about $50,000. So you'll save $50,000, and then you go, oh, it's great, my home loan's paying down 50 grand. Now I've got to go borrow $716,000 to buy this property. Aren't you best just to put the extra $70 into this, sell the property at this point in time, maybe, not saying that, come out with $316,000, pay 50 grand off the home loan and have 216,000 left over? Is that better? It is better. It is much better. But generally what happens is people just can hang on to that property and it becomes more positively geared beyond this. Okay, so let's have a look at, in regards to having a couple investment properties. Again, using that example, we bought a property worth $400,000, we borrowed $400,000, we hold on for 10 years, it's worth $716 per the previous slide. Equity, $316, the difference between the value and the debt. We buy another similar property, not the same property, say a very similar property, and over 5 years, that property's probably gone up from $400,000 to $535,000. So we buy property number 2, and 5 years on, it's gone up to $716,000. It's the same sort of property, we bought one 5 years later. So the equity in that property is $181,000. So we've got a debt of $935,000 and value of $1.4. We built up equity of $500,000. We hold on to both these properties for another 5 years. Okay, and the debt's the same. Why is the debt the same? Interest only. And the properties, instead of being $700 each now, are close to $900 and something each, a total of $1.9. So the equity's grown to $982. Another 5 years later, with this compounding effect happening, 6% a year, going up 6%. The next year, these two properties gone up $120,000, then another $130,000. And obviously over the next 5 years, it's gone up $650,000. So we've got two properties that originally cost us this and this, loans of $935,000, and we've got two properties worth $1.28 million each, a total of $2.5. The equity in the property, the difference in that is $1.6 million. I talked about the earlier slide, how much does Stavro need in retirement to generate $50,000 a year in income, which the answer was how much? $1 million. In this scenario, with two properties, quality properties in good locations, going up in value from the rent, equity of $1.6 million. So a rental yield on that, 5% is $125,000, let's say it's 4.5%, $115 grand. Interest at 6% on this loan still, $55,000. The difference is $60,000. Cover little costs, body corporate fees, a few of those on a couple of properties. Presto, $50,000 Stavro. All right, let alone superannuation, let alone any dividends with your 10 grand in Telstra shares, no, with all the other shares as well. And a pension income from your superannuation as well. So that would give you more than $50,000. Might have $80,000 or $90,000. Okay. So I think that's the last slide, guys. So that's about it. So hope you enjoyed that.